President Trump has unleashed a new wave of tariffs, targeting imports from major trading partners. These tariffs impose a 25% levy on goods from Mexico and Canada. Only Canadian energy imports face a lower 10% tariff. All Chinese imports will be subject to a 10% tariff. This marks a significant escalation in Trump's protectionist trade policy. The administration argues these tariffs are crucial for protecting American jobs. The president declared that America must prioritize its own interests. He emphasized the need for self-reliance in sectors like energy, automobiles, and lumber. Trump claims the US can prosper without relying on other countries. However, these pronouncements have been met with widespread criticism. Critics warn of severe economic repercussions. These tariffs represent a substantial gamble with the American economy. The announcement of these sweeping tariffs sent shockwaves through global markets. US stock futures plummeted immediately, reflecting investor anxiety over the potential fallout. The Dow Jones Industrial Average plunged over 600 points in after-hours trading. Other major indices, including the S&P 500 and Nasdaq, experienced similar declines. Cryptocurrencies also tumbled, with Bitcoin shedding significant value. This flight to safety pushed the US dollar higher. Energy markets reacted swiftly, with US crude oil prices surging. The automotive industry faces significant disruption. Shares of major US automakers experienced sharp declines. The most immediate impact of these tariffs will be felt by American consumers. While existing inventories might cushion the blow initially, price hikes on a wide range of goods are inevitable. The Tax Foundation, a non-partisan think tank, estimates that these tariffs will cost the average American household an additional $830 per year. Industries reliant on imported goods will face difficult choices. They can either absorb the increased costs, squeezing their profit margins, or pass them along to consumers. The latter scenario could lead to reduced demand and job losses, undermining the tariff's intended purpose. The agricultural industry, already reeling from previous trade disputes, is bracing for further pain. China, a major buyer of American agricultural products, has vowed retaliatory tariffs. This tit-for-tat escalation could devastate American farmers who rely heavily on export markets. Beyond the immediate price shocks, these tariffs threaten to unravel global supply chains that have taken decades to build. Businesses may be forced to relocate production or seek alternative suppliers. Adding complexity and cost to their operations, this disruption could have long-lasting consequences for global trade and economic growth. The international response to Trump's tariffs has been swift and resolute. Canada, Mexico, and China have all announced retaliatory tariffs on a range of US goods. This tit-for-tat escalation has raised fears of a full-blown trade war, with potentially devastating consequences for all involved. Supporters of the tariffs, like JP Morgan CEO Jamie Dimon, argue that short-term pain is a necessary price to pay for long-term gains in national security and economic independence. They believe that these tariffs will ultimately force trading partners to offer more favorable terms to the US. Critics, however, view these arguments as short-sighted and dangerous. They point to the potential for job losses, higher prices, and slower economic growth. The Peterson Institute for International Economics, a respected think tank, warns that these tariffs will harm American consumers and businesses far more than they will help. In the short term, businesses are scrambling to mitigate the impact of these tariffs. Some are stockpiling goods to delay the inevitable price hikes. Others are exploring alternative sourcing options or considering passing on the increased costs to consumers. However, these are stopgap measures. The long-term economic ramifications of this trade war remain highly